Tonight, I have the honor of being the moderator of our second community town hall with Rob Kaplan. This is our second virtual town hall in 2021, and I'm happy to say we're both vaccinated, and so we're adhering to CDC guidelines concerning masks and social distance. So our format this evening will be the same as our last town hall. Rob will start with opening remarks and let us know what's on his mind, and then we're going to open up to you, the audience, to hear what you're thinking and what topics you're interested in. Speaking of questions, there's two ways to ask a question. You can click on the Q&A button at the bottom of your Zoom screen and type in your question, or you can click on the raise your hand button and ask a live question. If you click on the button, it'll put you in the prompt in the queue, and we'll let you know to unmute and ask your question. We hope that you're going to be active tonight and participate by asking questions. So if you'd like to ask a live question, I think I've mentioned that, you can do that. And we have lots of questions that you've written in beforehand that we'll also get to, Rob. So no shortage of questions tonight. Let's get started. I'm going to introduce Rob. He is the CEO and president of the Federal Reserve Bank of Dallas. He's been serving in this role since 2015. Rob represents the 11th Federal Reserve District on the Federal Open Market Committee and in the formulation of monetary policy. And he oversees the 1,200 Dallas Fed employees. So without further ado, Rob.
Thank you, Elfrida. Great to see you in person. And it's great to be here. And thank you, everyone who's joining this town hall. We do extensive outreach in our communities. We spend a substantial amount of time in also our community efforts, which Elfrida leads. And so we're always glad to do these town halls and hear what your questions are and have a direct conversation. And so I'll say a few words just to update you on our economic forecast and two or three issues I think are worth mentioning. Then I'll throw it back to Elfrida and we'll go straight to the questions. First, our forecast at this point from the Dallas Fed for 2021 is for GDP growth in the range of 6.5%. There are private forecasters that have a more aggressive forecast than ours. We're aware of that, but our baseline is still 6.5%. Consistent with that, we would expect the unemployment rate to continue to drift down toward 4% as we head to the end of this year. And I'll say a few words about inflation. I'll probably save those comments on inflation and inflation dynamics I'll say that for the Q&A. We'll talk about that more in detail. There are a number of unique features and elements of this pandemic and the recovery. And I think the first thing I'd say is this is a very different downturn than the Great Recession, where we had over-leveraged banks, excess leverage in the financial system, and we had very high leveraged households in the Great Recession. And one of the issues we faced in the Great Recession and the aftermath is it took a number of years for households to deleverage, to help improve the unemployment rate. And as a result of that, we had demand challenges for a number of years coming out of the Great Recession before households were healed enough to start spending more. In this downturn, we had a very severe contraction, as you all know, in the second quarter of last year. But we began to recover in the third and fourth quarter, but household income in this downturn actually did not go down. In the Great Recession, household income declined substantially and consumer spending was severely weakened. In this downturn, consumer spending has stayed strong. And as we're going through 2021, we still see consumer spending is strong and demand is strong. What's one of the big reasons, though, why it's very different experience is we've had very sizable and targeted and rapid fiscal policy, which is a much higher percentage of GDP than what we had in the aftermath of the Great Recession. And also the nature of this pandemic is different. And I'll comment on that a little bit. And a lot of this you're painfully aware of. If you're in a business this last year and a half that was either in the goods sector where you were able to serve your customers or clients using technology and work remotely, which were a wide range of industries, you might have had a very good year. Your business did in 2020, and you're doing well in 2021. On the other hand, we know that if you were in the person-to-person contact service sector, restaurants, movie theaters, leisure, hospitality, and you couldn't use technology to continue to serve customers through pickup and other ways, you had a very difficult year in 2020, and you're likely just now emerging from some of those difficulties in 2021. Also, this downturn has affected the workforce very differently. If you've got a college education, it's very likely in this pandemic you didn't lose your job. It's very likely you were able to work remotely. And you might have done very well in 2020 again, and going through 2021 similarly. If, on the other hand, you're one of the 46 million high school educated or less workers in this country, and you don't have a skill, you are far more likely to have been in a person-to-person contact service industry. You're far more likely to lost your job, lost hours, and you've been very reliant on fiscal support, unemployment benefits, and the like to make ends meet. One of our challenges coming out of this pandemic is getting those high school and less educated workers back into the workforce. I'll get back into that in a moment. The other thing that we've seen that's very unusual in this pandemic versus the Great Recession is the impact on women with children. In the Great Recession, women with children did not fare materially differently than their male counterparts. They did in this downturn. Women with children have disproportionately left the workforce. We've seen the prime age participation rate for women with children drop a full 5 percentage points. And so that's one of our other challenges through this pandemic. Let me talk a little bit more about some of the later labor challenges, and then I'll probably stop after that. Based on everything I've just talked about, the other thing we're seeing, if you compare today versus February of 2020, it's our best estimate at the Dallas Fed that approximately 2 million workers, 55-year-old and older, have left the workforce and in fact designate themselves as retired. So that is a very significant chunk of the labor force. It's our estimate that approximately 1.5 million women with children who were employed again in February of 2020 have now left the workforce to be home to care for kids, either because lack of person-to-person availability of lack of in-person school or lack of availability of childcare. In addition, as you all have heard some of these stories, unemployment benefits are such that we're hearing broadly from contacts, not just in business, but Head Start directors, other community leaders, that many workers who made $12 to $15 an hour are reluctant or more reluctant to enter into full-time employment because of the generous unemployment benefits which go on through September. They might be working in contract jobs or day jobs or other part-time work for cash, but it's been a challenge for businesses to find workers to come back into the workforce, particularly at the lower end of the wage scale. And I guess I'll go a little further. We have regular calls with high school superintendents. They're telling us that whereas they would normally graduate, let's say 85% of the senior class, this year they're going to graduate closer to 65% of their senior classes. In other words, they're losing seniors. Their best judgment is those seniors have gone to help their families, care for siblings. And you noticed in the most recent jobs report, 16 to 19-year-olds actually was one group that had increased growth in terms of jobs. And normally you'd say on the one hand, that's a good thing, but the problem is a number of those 16 to 19-year-olds have left high school. This is a big issue to us because in order to go for skills training, you need to either get your GED or your high school diploma. And so we're concerned that over the medium term, this is a lack of supply for skills training. And we're also hearing, consistent with that, broadly from junior college superintendents throughout Texas in our district. They've seen a disproportionate drop in skills training enrollment, particularly among Black and Hispanic students. And so again, we're hearing from business, it's hard to find skilled workers, and we're worried over the medium term unless we can get high school students that have left high school back into high school so they can get their GED or get their diploma and improve enrollment in skills training. It's going to reduce the supply of skilled labor for a period of time, which also will have a supply effect on the labor force. So there's a lot more I could go into, but I guess that's enough to start. Let me stop there and throw it back to Alfreda, and then we'll go back into more detailed questions.
Yeah, lots going on. As I said, a lot of our audience sent in questions when they registered. And so I'm going to start with those as a warm up and get that started while we're getting questions coming in, both live and written questions coming in. So I'm going to get to some of the top of mind things: tapering and policy normalization. So here's a question: how can the FOMC manage speculation about when it will be appropriate to consider tapering asset purchases in a manner that avoids or minimizes disruption to financial conditions, as occurred, for example, in 2013?
So on the one hand, I've said the recovery from this pandemic, I think, is very different than the aftermath of the Great Recession. But one of the lessons, having said that, we did learn a number of lessons from the Great Recession. And while I wasn't at the Fed, one of the lessons I know that we've learned, and we've looked back at studying that period, is when you do ultimately adjust asset purchases, you're going to want to telegraph it in advance and give the market plenty of lead time to absorb that. And I think that is a good lesson to keep in mind. So our communication on this and doing this in a way that telegraphs it and lets the market adjust to it and get ready for it, I think is a wise thing to do.
Yeah, there's a follow-up to that. Someone asked about those guiding principles or signposts that you'll consider for timing the unwinding of the balance sheet. So are there any things in addition to sort of telegraphing? What else?
Yeah, so we agreed in December of 2020, we being the FOMC, that we would have a standard or benchmark of having reached substantial, quote unquote, substantial further progress. And we've intentionally left that undefined, but we need to have seen substantial further progress before we begin to taper. My own view is this: I think I support that standard, but I've also said, for me, what I'll be watching for is evidence that we've weathered the pandemic, which I think we're getting there now. Not fully there, but we're getting there, that we've weathered the pandemic in the United States and that we're moving toward making substantial progress on full employment and price stability. I've also said, though, so that's the standard for when we do it. I also have suggested that as we approach that standard, one of the things that I'm watching for is excesses and imbalances building in the economy. One of the things about buying 80 billion of treasuries and 40 billion of mortgage-backed securities is it has an effect on creating excesses and imbalances in financial markets, in housing, and in the economy. Can affect some of these supply-demand issues. And as a result of that, I've said sooner rather than later, I think it would be healthy as we approach weathering the pandemic and making progress on full employment price stability. I think it'd be healthy sooner rather than later to begin discussing the efficacy and the impacts of some of these purchases. And I'll give you one example as to why. We're buying 40 billion of mortgage-backed securities a month. House prices are now at historically elevated levels. But in addition, we're hearing increasingly widespread reports of private investors increasingly entering the single-family home market, buying often sight unseen, above asking price, and requesting the house is furnished. And my comment has been, those developments will occur, but is this a side effect or unintended consequences of continuing to buy 40 billion of mortgage-backed securities a month, even as the economy comes out of the pandemic? And I'm also aware that if housing prices appreciate rapidly, we will eventually see some of that translate into higher rents. And we're watching for that. And so what I've said is I think it would be healthy, again, sooner rather than later, to discuss some of these side effects, unintended consequences, and begin to have discussions about adjusting these asset purchases as we make progress in the economy.
Thanks for that. And in fact, that checked off several questions that people had on their minds. Let me ask you one more before I get to some of our live questions that we've got coming in. How is the Fed factoring in labor staying on the sidelines and the possible foreclosures, as you were alluding to, that have been placed on hold due to COVID when thinking about interest rate management?
So well, there's two. So let's start with the labor. I mean, one of the things going into the last jobs report, which is a week ago Friday, because we do so much outreach. My economic team in the 2 weeks leading up to that jobs report had warned this jobs growth number might be disappointing. In fact, it might be. Our own internal estimates were much less optimistic than what we'd seen by other forecasters. And it was because of these supply demand issues. And I mentioned them about retirees, women who've left the workforce, unemployment benefits. The other thing we're hearing widely from our contacts is because there are input shortages. What's an example? Semiconductors. If we didn't have the semiconductor shortage, I think you'd see more car production. And this is also one of the reasons why we saw a jump in used car prices, because there's a lack of supply of new cars. But the point is, that's caused a number of manufacturing industries to also limit jobs. So what's the point of all this? There's a healing and adjustment process that has to go on. And we're well aware of it, and we take into account, it's not, the key is, it's not a demand issue. We think demand has been strong, and I think may continue to strengthen as we reopen. It's going to shift by sector. But we understand as we recover, we're going to have to be aware that you're going to have these dislocations and imbalances, and we've got to take that into account and think about it. I would say this monetary policy is well equipped to deal with demand issues. It's a little less well equipped to deal with supply issues. And I think there are other structural remedies that can better deal with supply issues necessarily than monetary policy.
Yeah. Well, let's go. We've got several people that are in queue here for live questions. So I'm going to reach out to Dee Dee Weinblatt. And Dee Dee, once you can unmute and ask your question, please. Are you there, Dee Dee? Still have a red mark on that.
Okay.
If not, I'm going to go to Jack.
Yeah.
Jack, if you unmute, you can ask your question.
Yes. I'm becoming extremely concerned about overreach of the Fed. Now, let me preface this understanding that I believe the Fed did a lot of right after the Great Recession, and I also think it's doing a lot of right now too. But I think it's forgetting its own place in the market. And I want to know what you feel about being the investor and also the lender of last resort. And are you really understanding the strength of that position and
Right.
not really wondering about how you should be allowing the market to function normally rather than be dependent on your actions?
So,
For instance, let me just give you an example, easy example. I know I don't want to get into an argument about what women want, okay? But there is a lot of people that I know that are out there that says American families are now dependent on two incomes, not one, like in the past. Now,
okay.
there's a lot of ways that that could be worked out, but aren't your actions, without thinking about you as what the Fed is it's a major actor in the market right now?
Right.
Aren't you
So
squeezing
I
out
got the threat.
those?
Let me just, in the interest of time, let me try to answer your question. So, and I've said this publicly before, when we're in the middle of an emergency or a crisis last year, I thought it was very appropriate for the Fed to use its tools aggressively to try to help us get out of the challenges that we're in and help the economy recover. As it's clear that we're weathering the pandemic and moving toward full employment and price stability, I do believe it is wise sooner rather than later to talk about adjusting our purchases and reducing our imprint on the financial markets through our treasury purchases and through our mortgage-backed purchases. Has to be done in an appropriate way with appropriate communication and in a gradual way. But I do think the U.S. economy will be far healthier when we're able to wean off these extraordinary measures. And I personally think it would be wise from a risk management point of view to start reducing some of these excesses and imbalances that come as a result of our asset purchases.
We've got some questions about inflation, Rob. One that was written in and one that just came in just a minute ago. Inflation appears to be on an upward trend, and someone has just typed in, is stagflation a possibility in the coming 12 months?
So we are watching very carefully. We've got input supply demand imbalances. It's, metals, building materials, lumber, semiconductors, food products. And we've also got, as I just went through, some supply demand issues on labor, which is going to affect, and listen, it's healthy to have higher wages, but this is having some supply demand effect on wages also. So we are forecasting that you're going to get an elevated year-over-year comparison in headline PCE inflation with last year. A year ago, the months of April, May, June were very weak. And so we think you are seeing and you're going to see elevated headline PCE readings. Those comparisons will get a little better as we head into the fall, but we still think we're going to end the year based on our forecast of the Dallas Fed. We're still going to be running a headline PCE inflation that are elevated levels. It's uncertain as to how long these supply demand imbalances are going to persist, and our base case is that next year you'll see some moderation, but I think there's a lot of uncertainty about this. So the smartest thing I can do in this job is keep doing our work, keep really trying to be very close to understanding how these imbalances are working, and also acknowledge that that while we have forecasts, there are a range of possible outcomes, and we're never going to know with certainty which one of them is going to actually happen. And so I'm a business person by background. And so when you have a potential range of outcomes, my job is to be a good risk manager and also to guard against tail risks. We have a commitment at the Fed that inflation will be anchored at 2%. We're willing to run moderately above, but I'm going to want to continue to see that as we get through this reopening period and we see this price surge, I'm going to want to be monitoring very carefully to make sure that inflation expectations don't get to the level that's inconsistent with anchoring inflation at 2%. And I don't think people listening should doubt the Fed's commitment to achieve that. My only other comment from a risk management point of view is I think it's easier to take your foot off the accelerator gradually and do that sooner rather than later than keep the accelerator depressed and having to step on the brakes down the road. And so as a risk manager, we have the tools to manage this, but sometimes they're more jarring when they're late. And so I've said this a number of times publicly. You don't want to be too preemptive, but you don't want to be so reactive as to be late. And this is part of the reason why I've said I'd rather start these discussions regarding asset purchases sooner rather than later in order to manage these risks.
We have a question, someone on the line, Jason Leader. If you unmute and you can ask your question, please.
Okay.
Yes.
Okay, great. Thanks, President Kaplan. I've
Hi,
got
Jason.
two questions. Hi. The first is, were you surprised by the April inflation readings? And then the second is, since December, things have improved significantly with the rollout of the vaccines. You know, the economy's improved quite a bit. Inflation seems like it's up. You know, obviously some is base year effects, some is short-term bottlenecks, but it seems like some are not, and some might be more durable. So I'm wondering, and as you mentioned, which I thought was very thoughtful as well, that there's a range of outcomes, there's probabilistic different paths. There's not just one path that's 100% certainty. So with that, it seems like I could see how someone can almost make an argument for tapering. But what kind of I scratch my head on, and I don't fully understand, is not talking about tapering right now, at least internally within the Fed. It seems like with a different range of outcomes, just talking about it internally, it seems kind of like a no-brainer to me.
All right, so let me talk about the inflation report. We were expecting something that was elevated. What I predicted exactly the CPI number that came out. I don't think me or my team would have. We weren't trying to predict a number, but we knew based on all our work and our discussion with contacts, you're going to have an elevated print. So it was consistent with that. And I think the year-over-year comparisons, by the way, are going to be challenging for next month too, based on what we think. So that's number one. Having said that, we did an analysis that we put out in our blog, and you ought to look at our website. We put out a blog, I think it was last Thursday. What we like to do at the Dallas Fed is compare prices to pre-pandemic levels. So our team did an analysis, which I thought was very helpful, where we compared last week's print to February of 2020. When you look at it that way, you'll see that we were up year over year 2.6%, still elevated, but not as elevated as the headline suggested. And the other thing I'll mention, we saw used car prices were up 10%, airline fares were up substantially, but even with that, a number of prices are still not yet back to February 2020 levels. So some of this has to do with the reopening. So we're obviously spending an enormous amount of time on this. On your second comment, well, I mean, I don't know what to say other than I have said publicly now a number of times as we approach evidence that we're weathering the pandemic and we're making progress on our full employment and price stability objectives, I would advocate that we begin discussing sooner rather than later these purchases, and particularly focusing on some of the side effects and maybe unintended consequences. And I gave the example of our mortgage purchases in the housing market as one case in point.
Rob, a couple of questions on the deficit. Someone has written in, can you comment on the federal debt level as a percentage of GDP and what the outlook is for reducing that number? And follow-up is that.
So let's stick with that.
Yeah.
We'll take these one at a time. And then we'll go to the follow-up. So I said consistently, as you know, pre-pandemic, leading into the pandemic, not knowing it was going to happen, what I've been saying is the path of US government debt to GDP is unlikely to be sustainable. Okay, at that point, I said that I think debt to GDP, debt held by the public was about 77% of GDP, and the present value of unfunded entitlements was in the neighborhood of $65 trillion. I don't need to tell you, we've now got that 77% is now in the neighborhood of around 100%, and present value of entitlements continue to build. And so we are going to have to find ways as we emerge from this. We've got to find ways to moderate our debt growth. And the reason it's complicated, yeah, there could be discussion about entitlement reform, sensitive subject, ways to raise revenue, very sensitive subject, which I'll stay away from, but that's got to be part of it. But the other things that could help moderate debt to GDP growth are growing the labor force faster and growing productivity faster. We're in an aging society. Labor force growth is decelerating. It means GDP growth, all things being equal, will decelerate if you can't find ways to address that. And so this is where the immigration debate, another sensitive topic, probably has to be on the table as we get on the horizon. And we've done a lot of work to suggest that we need to restructure our immigration to be much more like Canada's, more skill-based and employer-based, but we need better workforce growth. The other thing is, in terms of productivity, skills training, improved early childhood literacy, all the things you work on every day, Wi-Fi. There are some investments we can make that I think will help improve productivity. So again, we can grow faster while we're doing all these other things to moderate debt growth. And so all that's on the table, and we're going to need to be focusing on all those things because I think we do need to moderate our debt growth. Last comment, the only reason or the main reason we're able to run this high level of debt to GDP is because the dollar is the world's reserve currency. And I'm hopeful that will continue for years to come, but there are always threats, seen and unforeseen, technology and others. And I think we make a mistake to rely so heavily that that's going to last indefinitely. I think we're going to have to find ways to moderate our debt growth.
Well, thanks. And that really addressed that follow-up, which is about will the federal borrowing become too burdensome? So I think you covered that well. We have Suzanne Buss on the line. And Suzanne, if you would unmute, we'd be happy to hear your question. She's still there? Oh, there you are.
I don't have a question. I'm sorry. I don't know why it said I had a question. Thank you. Thank you.
We're now dragging in audience members. This is what it's come to. Yeah.
Well, we do have Franklin. Franklin Esting is on the line. Franklin, if you would like to unmute and ask your question.
Yes. Can you hear me?
Yes, sir.
Okay. Thank you very much. I had a question about, so I noticed that I've been seeing that market expectations of short-term interest rates, like through various futures, like Eurodollar futures, predict that rates will rise. Many predict that rates will rise in 2023 or earlier, whereas FOMC policymakers have indicated that through their forecasts that rates should rise no earlier than 2024. Are you concerned about this discrepancy, and do you think that markets will change their expectations in the near future?
So You're referring to the Fed, about the part of what Fed policymakers have said. You're referring to something in the lingo called the dot plot. Every
Yeah,
3
exactly.
months, every Fed president and the governors submit our estimates for the economic forecast for this year and for next year and the year after, and what our path of rates is. And I'll just mention the median of the dots was not raising rates until when you said, but I will say there were 4 or 5 participants that had a forecast of beginning to raise rates in 2022. And I guess I've said publicly, I'll just acknowledge I was one of those that my first rate increase based on our forecast here was 2022. And I haven't seen anything since I submitted that in March. I haven't seen anything from that point to today that's changed my view that is the more likely path, because I think by that time we will be in 2022, we have a good chance to be at full employment, to have an inflation rate certainly that's at 2%, and with every prospect that'll be running moderately above 2%. But that's our standard. And if that benchmark changes or we don't achieve those, I'll change my views. But based on my current forecast, I would say what I just said. In terms of market expectations, I was in the markets for most of my adult life. And the one thing I've learned about them, they can change on a dime and they'll change with circumstances. So you might go for periods of time where there's a disconnect, but I don't know that disconnect will last indefinitely.
Great. We're getting lots of write-in questions. So
Okay, good. That's good.
Hope you're ready. But also don't forget, if you want to ask a live question, just click on the raise your hand button and get in the queue and we will answer your question. Someone's asking about the explosion of what else? Cryptocurrency.
Right.
What's your thinking on that?
Well, there's lots of different types, and just for the audience, I'll differentiate between a digital RMB, Chinese currency, or a digital dollar, and crypto. Crypto right now, Bitcoin, and there's all the derivations of it, have so far proved to be store of value, and people are investing in them as an alternative, say, to gold. They want alternative to paper currencies. It's not tied to any one currency. And I will tell you, we've done a deep dive here in studying Bitcoin and other currencies and the technology of distributed ledgers, blockchain. I think the technologies are being used now much more broadly. I think I'll have a better prediction in hindsight, and I won't try to predict how those cryptocurrencies were fair. For the Fed, though, I'm much more focused on a digital dollar, which would be tied to an underlying currency. Much more of our economy right now, payments, is already digital, and I think we'll be studying that. But it's different than crypto. It's not, which is intended to be a store of value. It's been so far, while some people have said they'd take it as a medium of exchange, it's been volatile enough that it's not yet widely adopted as a medium of exchange. In terms of the speculative aspects, I'll defer to others outside the Fed. I have my own private views, but I'll refrain from giving them in a public forum.
Well, now that you've made that distinction, I think this is a good question about digital currency. What are your thoughts on the various digital currency experiments by central bank? And do you think any of these could affect the future of the US dollar as the global reserve currency and the currency most global trade is?
So the one that comes up most often is the experiment that China's doing with the yuan, where they've literally disseminated a digital wallet to their citizens, and they're basically running an experiment to see how it works. Now, there's been a lot of speculation that that's step one, and that eventually China would like to use a digital currency for global payments to encourage more adoption of their currency over, say, the dollar. Having said that, there's a whole series of, I would think, reforms and changes China is going to need to make to have that succeed, which could take many, many years or decades. One of them is a worry about exchangeability of the currency. Do they have currency controls and all that? But so this is a step in maybe multiple steps. We're watching it carefully. I don't think it's near term, again, that this would impact the dollar, but I think it does remind us that we're wise not to assume that dollar dominance will last forever. There will be threats seen and unforeseen. And I think the US also, we should be doing work in studying, and we are here at the Fed studying a digital dollar.
Thanks for that. I'm going to change gears a little bit.
Yeah.
We've got several questions coming in talking about inequity and the wealth imbalance in the country, and wanted to get your comments on that.
Yeah, so there's two key things. There's income inequality and wealth inequality. Going into the pandemic, we were making progress on the income side, in that we had a very low unemployment rate. We were drawing in underrepresented groups. Wages at the low end were rising, and we're making some progress. There were still issues with widening wealth inequality because those who have financial assets and those that don't. The pandemic, unfortunately, exacerbated all this. We took a big step backward because the groups most disproportionately affected in the pandemic were these underrepresented groups negatively. And some of the remedies that we used in terms of 13.3 programs, asset purchases, were one of the side effects, and they were very beneficial to financial assets. And if you do, lower income people don't tend to have savings or financial assets. So if you did, you relatively fared relatively better. And so we're very aware of all this. And the only comment I would make is our desire at the Fed, through not only our monetary policy, but through our community outreach, is to create a more inclusive economy. But I also think it's wise, and it's wise for us to acknowledge and be very aware of the effect of some of our actions and monetary policy on asset prices, and making actually wealth inequality more significant. And I think it is wise for us to acknowledge that. And that's why, again, I think we'll be healthier as a country to the extent we wean off some of these extraordinary actions as soon as we're able to, because I think it will be helpful in this regard.
There were questions about, you mentioned the skills training that needs to be happening. And there were some questions about how do we close that gap on worker skill training? Any ideas on that or anything?
Yeah, so for starters, there's no getting around that beefing up skills training. You can have federal money to help, but the actual training needs to happen locally. And so what do I mean by that? And this is why it makes it so hard. You need high school superintendents and junior college presidents, and we're blessed here in Dallas, but also in Houston, El Paso, other parts of this state. We've got great high school superintendents and junior college presidents, and we talk to them who go out, interview businesses, find out what the open jobs are, backward integrate into curriculum, work in partnership with those businesses who often help pay for them, supply the faculty, and local city leaders and state leaders. And I think that ecosystem, continuing to beef that up, would help improve the supply of skilled workers. There is a skills gap in the United States. And the reason, again, this has been so hard, it's more than about money. You need local high school and junior college superintendents who change the way they operate. It's no longer sufficient to say, here's our curriculum, you should want this. You have to go out there to businesses, interview them, and backward integrate your curriculum. And I think, again, that's the new age high school superintendent and junior college president. And we're blessed with a number of them in Texas, but we need more of it nationwide. And we've got a long way to go. It's critical, though, in this country. And you talk about income inequality and wealth inequality. To the extent we can get more people in skills training, these are high-paying jobs. People don't realize how much an automotive technician and IT specialists get paid. These are very good-paying middle-class jobs, and businesses can't find enough people to fill them.
Yeah. We have another caller, Bill News, on the line. And Bill, if you unmute your mic, we'll take your question.
Hey, Rob, how you doing?
Good. How you doing?
I'd like to get your perspective on price of oil. There are a lot of things going on in the world, the energy transition, the Colonial Pipeline issue recently, a lot of underinvestment in the industry over the last 5 years after the oil price crash. There's a lot of moving parts. I'd be curious to know what your outlook is. So,
Leah, let me tell you what we're seeing. So I don't need to tell you, in 2020, the industry not only had a demand shock, it had a supply shock. Demand fell off because of COVID. People stopped driving and flying. And in addition, Saudi Arabia and Russia decided to increase production. They ultimately stepped back from that decision, but for both those, you had a big inventory glut. We still have not worked off, based on our estimates, all that excess inventory, but we think that is going to happen by the end of this year or early 2022. In the meantime, the industry, and this is the fossil fuel part of the energy industry, has gone through a dramatic consolidation. Number of firms have failed, workers have lost their job, firms have deleveraged. It's a much more consolidated industry now and streamlined. And the other thing about the industry, it has not been able to attract capital. So we track capital flows. This industry cannot attract capital. And in addition, participants in it have committed to their shareholders that when they get cash flow, they're going to use more of that cash flow to return capital, either in share repurchase or dividends, and less of that cash flow is going to go to drilling. So the long and the short of that is, we ended last year in the US with production about 11 million barrels a day. And even with meaningfully higher prices, what we're seeing, it's our best judgment that we'll only increase production this year, maybe to 11 and a quarter, maybe 11 and a half. In other words, not as much as we'd historically expect, because again, the industry has tightened its belt and it's returning more cash to shareholders, spending less on drilling. All things being equal, depending on what OPEC does, that's why it's not surprising to see prices firm. And OPEC so far has been very disciplined about supply. But I think the challenge for the United States, so I guess that's the nature of the industry right now. The challenge for the US is capital is flowing aggressively to wind, solar, which, by the way, we have significant leadership of that, of both industries in Texas, but more wind, solar, battery storage, and the producers of oil and gas are spending a lot more money, billions, on sequestration and techniques that limit greenhouse gas emissions. And so our estimate also over the next number of years is fossil fuel will be a smaller and smaller percentage of total energy consumption in the United States and globally. Having said that, that's not to say that there isn't going to be substantial demand for fossil fuels. And our best guess is demand for fossil fuels will be strong, even though a smaller percentage of the total, not for years, but for decades. So the challenge for the US is to make this transition, but yet have enough production to meet demand. Because if we don't have that and we have these outages, you're going to get price spikes and they're going to hurt millions of consumers and probably those least able to weather it. So that's the challenge for the United States. Aggressively make the transition, but you need a healthy fossil fuel industry.
Well, that's the United States. Let's turn to Texas.
Okay, let's.
Lots of people are coming to Texas.
Yes, they are.
We've got a question that was written in. Do you see any foreseen any increased economic pressure, whether supply or demand, on the Texas economy with the influx of residents from other states, such as California, New York, sustained housing prices rising, traffic?
So the story of Texas pre-pandemic over the last 10 years was population growth from 22 million people to 29 million people. And a meaningful percentage of that growth was migration of people and firms to the state. And the state's economy got more diversified. Pandemic starts, and if anything, as you just said, this migration is accelerating, okay? And so the good news about that, and I'll get through some of the strains. The good news about it is I talked about GDP growth earlier, growth in the workforce, growth in productivity. Texas has got strong workforce growth, and it's going to continue to have it for years to come. And by the way, if we continue to improve education and skills training, that will also help. And so we've got the wind at our back. But one of the short-term side effects of all this migration is I mentioned about excesses in the housing market, and this migration has just further exacerbated that. And so for a lot of families who lived here want to buy their first home, it's more expensive. Rents are going to go up, and there's going to be, I think, more supply ultimately come, but supply takes time. And so obviously strains on infrastructure and other elements of the state, but I think the state's got the ability to address all these issues, and we've got the money to address these issues. But yeah, this is a high-class problem for Texas, but yeah, it will create some strains, and in the short run, at least housing is one of the ones we're seeing.
Yeah, also with the pandemic, obviously we're all working at home,
Yeah.
many of us. So we have a few questions around sort of the new normal. Do you think businesses will continue to allow and encourage remote working?
Yeah.
Which industry sectors will be most affected positively or negatively if workers continue to work from home?
So every business, and we're having these own conversations here at the Dallas Fed. We have 1,300 employees in this district, but we're having this conversation with every business. And I'm talking to CEOs several times a day, either telling me that sharing their plans or asking advice. And the short answer, it depends on the industry. If you run a restaurant, your people are going to have to come back. If you work in a sports stadium, in a movie theater, leisure, hospitality, a lot of hotel staff, it's been a real challenge to attract. The hotels are telling me as they're reopening to attract staff, airlines. And so there's certain jobs you have to come in person. Having said that, most other businesses I talk to are now more convinced from this period that remote work can work. Maybe their employees don't have to come in 5 days a week. Maybe they can come in 2 days a week. Maybe certain functions can work more remotely. Higher education has realized, colleges have realized that maybe one part of their offering that you can have more in the future is students remote and teachers remote. In the education system, unfortunately, in high school, we've learned that if you're going to do remote, students are falling behind. And I think a lot of the high school superintendents want to get all their teachers back and get all their students back, because maybe remote, especially for certain students, has not worked out so well. But it's going to vary by industry, and almost every leader is agonizing through this and probably is going to try some experiments, including we are here at the Dallas Fed. We're going to try some things and encourage our employees to be flexible. And we're going to work our way through this. And I think that's what most businesses I talk to are saying.
Yeah. We have Byron Wayne on the line.
Oh, my Lord.
And Byron, if you want to unmute, we'll take your question.
Hi, Byron.
I continue to worry about the inflation issue. You cited autos and airline fares and so forth. It just seems to me with some portion of the American Jobs Plan and American Family Plan, the combination of what the Fed is doing and what is happening on the fiscal side is putting a lot of money into the system. And I'm terribly worried that inflation is going to plunge through 2% and be something you're going to have to deal with. What factors are you looking at? What indicators would suggest to you that perhaps it isn't transitory?
Yeah, so you may have heard my answer earlier. we're going to see elevated inflation readings even after these weak comparisons wear off as we head into this year. You're going to end the year with a more elevated reading. What you worry about is if these supply demand issues, including for labor, take longer to resolve and are more prolonged, it starts to feed into inflation expectations. And we're watching those very, very carefully because you don't want to see inflation expectations develop at a level that's inconsistent with anchoring inflation at 2%. And this is why I said earlier, Byron, my job is not necessarily to predict the future with complete accuracy because I can't, but it's to realize that and to be humble about it and to realize my job is in part to be a risk manager and to guard against tail risks. And so that is part of the reason why, that is one of several reasons why I have said sooner rather than later, I think it would be healthy to begin discussing adjustment to our asset purchases as we approach making progress in emerging from this pandemic. I think it would be healthier to have those discussions sooner rather than later. And I'll say it again, I think it is preferable from my point of view to ease off somewhat the accelerator in order not to have to hit the brakes somewhere further down the road. We have tools to deal with inflation, but if we need to use them, they can have some jarring effect. So I'm basically saying sooner rather than later, I would like to see discussion of this. And partly for me, it's from a risk management point of view.
I'm going to squeeze in one more caller here. Robert Sakowitz is on the line. Robert, if you could ask your question, unmute, please.
Rob, the question I have is with regard to the ports and shipping and the lack of containers because of our lesser exports compared to all of these imports. And
Right.
we have this balance internationally. A, how do we start getting back into a positive exports? And B, this long-term, this container shortage, literally what cost $2,600 from Ningbo is now up to $8,000. It's impacting an awful lot of things. We talk about inflation.
Yeah. So Bob, so we spent a lot of time talking with as you know, leaders of the ports. And so number one of the concerning things, what U.S. is recovering, that's positive. It's not perfect, but we're vaccinating more and more people. But around the world, they are severely lagging behind us. One of the negatives of this severe lagging is it affects global demand. It affects our imports and exports. It helps create some of these supply demand issues. And we're seeing that. And so to the extent the United States makes a decision to export vaccines and help the rest of the world get vaccinated, I think you'll see that help this situation. And in the meantime, we're going to see these imbalances. I'm talking to every one of these industries that are affected, and the estimates vary how long it's going to take to resolve these imbalances. But a faster recovery outside the United States and improved vaccinations is going to be one of several elements that'll help address this.
Well, I want to thank all of our audience members for their questions, their thought-provoking questions. And I'm going to ask the last one for the evening.
Sure.
Rob, what keeps you up at night?
There's no textbook for this recovery. I don't think the aftermath of the Great Recession is a good template for this. We've got a unique set of challenges, and I think the smartest thing I can do in order to avoid staying up more at night is to acknowledge the uncertainty and what I don't know. But then the second thing then is how do you manage the risks when there's a range of outcomes and there's a lot of uncertainty, and some of the things we're seeing are unprecedented. I want to make sure that that in this job we're nimble enough to make the right judgments and to balance the risks and manage these risks and guard against more extreme outcomes on either side. And so those are the things that I lay awake at night to try to think whether we've got this balance right.
Great. Thanks again, everyone, for joining us tonight. We hope to see you next time. The Dallas Fed is committed to our communities and to sharing information broadly. And if you're interested in learning more about the Dallas Fed, visit us at dallasfed.org. Sign up for future events, for our global perspectives, our conferences. We'd love to see you again. So until next time, thank you.
Thank you,
Good
Alfreda.
evening.